Investing is exciting. There's a unique rush that comes with putting your money to work, watching numbers change, and imagining the possibilities for your future. Every click, every update, can feel like a step closer to your dreams. It's a way to grow your money, chase dreams, and reach financial freedom. For many, investing represents hope, a chance to build a better life, provide for loved ones, or simply enjoy more choices down the road. Many people, from beginners to millionaires, jump into investing, hoping to make their fortunes. The world of investing is open to everyone, regardless of background or experience. The promise of high returns, the stories of overnight successes, and the buzz around new trends make it tempting to dive in, head first. Social media and news headlines often highlight the wins, making it easy to believe that anyone can strike it rich overnight. But before the rewards, there are risks. Sometimes, even the richest, smartest investors make costly mistakes. No one is immune, not even millionaires with teams of experts. The market can be unpredictable, and emotions can cloud even the sharpest minds. The truth is, investing isn't just about picking the right stocks or properties, it's about avoiding the wrong moves too. Success often comes from careful planning, patience, and learning from past errors. Many regrets come from simple errors that could have been prevented. Sometimes, it's a lack of research, acting on impulse, or following the crowd without understanding the risks. In this essay, we'll explore the most common money mistakes people make before investing. We'll break down the pitfalls that trip up even the most experienced investors. We'll look at why these blunders happen, even to the wealthy, and what you can do differently. Understanding the reasons behind these mistakes is the first step to avoiding them. Along the way, you'll discover easy tips and real-life lessons that can help you invest with confidence. These strategies are practical and can be applied by anyone, no matter where you are on your financial journey. So, whether you're starting out or already growing your wealth, these insights can save you from regret. A little knowledge now can make a big difference in your future. Let's learn from the experiences of those who've walked this path before us. Their lessons can become your success. By understanding both the thrill and the peril of investing, you'll be better prepared to make smart, confident decisions. Have you ever heard about a can't-miss investment? These are the opportunities that everyone seems to be talking about, promising quick riches and easy wins. Maybe your neighbor made a fortune in cryptocurrency, or everyone at the office is talking about the next big tech company. Social media is full of stories about people striking it rich overnight, and it feels like everyone except you is cashing in. It's easy to feel left out and want to join in, especially when it seems like you're missing out on a golden opportunity. This is called following hot trends, and it's one of the oldest and most common traps in investing. The pressure to act quickly can cloud your judgment. Why do people make this mistake? The answer is simple: FOMO, or fear of missing out. It's a powerful emotion that can push even experienced investors to make rash decisions. When you see others making quick money, it's tempting to jump in without thinking. The excitement can be contagious, and it's easy to forget the risks. Even millionaires can get caught up in the hype, believing that past results guarantee future gains. But markets don't work that way. What goes up quickly can come down just as fast. A classic example is the dot-com bubble of the late 1990s. Back then, people rushed to invest in internet companies, convinced they couldn't lose. People invested in internet companies without understanding what those businesses even did. Many didn't bother to research or ask questions. They just followed the crowd. Many lost their savings when the bubble burst. The dream of easy money turned into a harsh reality for countless investors. The same happened with certain cryptocurrencies and meme stocks in recent years. The pattern repeats itself whenever hype replaces careful thinking. To avoid this trap, always ask yourself, do I really understand this investment? Take the time to learn before you leap. Don't buy just because everyone else is. Remember, following the crowd can lead you off a cliff. Do your own research, and remember that successful investing is about patience and discipline, not chasing the crowd. True wealth is built over time, not overnight. Imagine going on a trip without checking the weather or packing a map. Investing without research is just as risky. Many new investors, and even some wealthy ones, skip the homework. They buy stocks, real estate, or funds without learning the basics. This mistake happens because people want quick results. Reading company reports or understanding how markets work takes time. When money is on the line, skipping research can lead to big regrets. Even millionaires admit they've lost fortunes by trusting rumors or tips instead of facts. For example, some investors put money into businesses just because a friend recommended them. Later, they discover the company isn't as strong as it seemed. These losses hurt more because they could have been avoided with a little effort. To avoid this mistake, make research a habit. Read about the investment, learn the risks, and check its history. Ask questions. A little time spent learning now can save you from painful surprises later. Investing can make your heart race. The ups and downs of the market can feel like a roller coaster, and it's normal to feel anxious when your money is on the line. When prices go up, it's easy to feel excited and greedy. The thrill of seeing your investments grow can make you want to buy even more, hoping the good times will never end. But when prices fall, panic can set in. You might feel the urge to sell everything just to stop the pain, even if it means taking a loss. These emotional swings lead to poor decisions, even for experienced investors. No one is immune to the powerful pull of fear and greed. Why do emotions get in the way? Money is personal. It represents our hard work, our dreams, and our security for the future. We want to protect it, grow it, and avoid loss. That's why every decision feels so important. But fear and greed are powerful drivers. They can cloud our judgment and push us to act impulsively. During market booms, people often rush to buy at high prices because they don't want to miss out on the excitement or potential gains. During crashes, they sell low to stop the pain, locking in losses that could have been avoided with patience. Both choices lead to regret. Acting on emotion rarely leads to long-term success. A famous example is the 2008 financial crisis, when panic swept through the markets. Many people sold their investments at the bottom, locking in losses and missing the eventual recovery. Years later, markets recovered, but those who sold missed out on the rebound and the chance to rebuild their wealth. Even millionaires have made the same mistake. Letting feelings override logic and discipline. The solution is simple: plan ahead. A solid plan can help you stay calm when emotions run high. Decide before you invest how much risk you can handle. Know your limits and stick to them. Set clear rules for when to buy or sell, so you're not making decisions in the heat of the moment. Remind yourself that ups and downs are normal. Markets will always fluctuate, but your plan can keep you steady. By taking emotions out of the driver's seat and letting your plan guide you, you can make smarter, more confident choices for your financial future. Mistake number 4 is ignoring hidden fees. Fees may seem small, but they can quietly eat away at your returns. Many investors, rich and poor, ignore how much they're paying in hidden costs. These fees can come from mutual funds, advisors, or even from buying and selling investments too often. This mistake is common because fees are often buried in fine print. They may look harmless, just 1% here or 2% there, but over time, those percentages add up. For example, paying a 2% fee every year can cut your wealth by almost half over several decades. Take the story of a millionaire who invested in expensive funds without checking the fees. Years later, he realized he'd lost hundreds of thousands of dollars to hidden costs. If he had chosen lower fee investments, his nest egg would be much bigger. To protect yourself, always check the fees before you invest. Compare different options and ask questions if you don't understand the charges. A little vigilance now can make a big difference in your future wealth. Mistake number 5. Putting all your eggs in one basket. Diversification is a fancy word, but it means something simple. Don't bet everything on one thing. Many investors put all their money into a single stock, business or property, hoping for a big win. When it goes wrong, the losses can be devastating. This mistake happens because people get overconfident. They believe their choice will be the winner. Even millionaires have fallen into this trap, thinking they can't lose. But markets are unpredictable. Even the best picks can fail. Think of it like a farmer planting only one type of crop. If a storm comes, the whole harvest is lost. But if he grows many crops, he can survive bad weather. The same goes for investments. Spreading your money reduces the risk. To avoid this mistake, invest in a mix of assets, stocks, bonds, real estate, or even different industries and countries. This way, if one area falls, others can balance it out. Diversification is a simple shield against big losses. What do wealthy investors wish they'd known before they started? Many say they wish they understood the basics better. They regret not learning about fees, emotions, or the power of patience. Some wish they had started smaller or asked more questions before trusting experts. One common regret is not having a plan. Many millionaires admit they jumped into investments without clear goals. They wish they'd thought more about what they wanted, whether it was steady income, long-term growth, or something else. Without a plan, it's easy to get lost. Others wish they had trusted themselves more. They followed the crowd or took bad advice only to lose money. They learned, sometimes the hard way, that no one cares about your money as much as you do. The good news: you can learn from their regrets. By building your knowledge, setting goals, and staying curious, you'll avoid many of the mistakes that even millionaires make. Good investing isn't about luck, it's about habits. Start by setting clear goals for your money. What do you want to achieve? Buy a home, save for retirement, or build wealth for your family. Knowing your why helps you make better choices. Next, commit to regular learning. Read simple guides, follow trusted experts, and ask lots of questions. Don't be afraid to admit when you don't understand something. Knowledge is your best defense against mistakes. Be patient. Investing rewards those who think long-term. Ignore the noise and stick with your plan, even when others panic. Revisit your investments once or twice a year, not every day. This helps you keep emotions in check. Finally, remember to review fees, diversify your investments, and avoid chasing trends. Small, smart steps lead to big results over time. Anyone can build these habits. It doesn't matter if you have $100 or $1 million. Investing is a powerful tool, but it comes with risks. Even millionaires stumble by following trends, skipping research, letting emotions rule, ignoring fees, or failing to diversify. These mistakes cost time, money, and peace of mind. The best investors learn from these errors. They build good habits, stay patient, and keep learning. They know that slow and steady wins the race. With a little care, anyone can avoid costly regrets and grow their money safely. Remember, you don't need to be a genius or a millionaire to succeed. Ask questions, set clear goals, and focus on what you can control. The journey to wealth is built on smart, simple steps taken one day at a time. So take a deep breath, start small, and invest with confidence. Your future self will thank you for every wise choice you make today.